एक सेकंड में चेक कर लेता हूँ कि सारी चीज़ें सही चल रही हैं नहीं चल रही हैं, वॉइस वगैरह, और फिर विल बिगिन with the 12th chapter, that is Japanese trading, right? एक सेकंड में चेक कर लेता हूँ कि सारी चीज़ें सही चल रही हैं नहीं चल रही हैं. Okay, things are fine. Just give me 1 second. Japanese candlesticks. Okay, so basically this is chapter number 12th, that is Japanese candlestick, and book is again the same, technical analysis of the financial market. And yes, we'll start with introduction, page number 275 out of 501. So yes, introduction. While the Japanese have used this charting and analysis technique for centuries, only in recent years has it become popular in the West. The term candlesticks actually refers to two different but related subjects. First, and possibly the more popular, is the method of displaying stock and futures data for chart analysis. Secondly, it is the art of identifying certain combinations of candlesticks in defined and proven combinations. Fortunately, both techniques can be used independently or in combination. Hi Boity, welcome to the live stream. So yeah, I hope you are having a wonderful day. Hello, welcome to the live stream. Candlestick charting. Charting market data in candlestick form uses the same data available for standard bar charts: open, high, low, and closing price. Okay, see, basically a candle represents or generally gives us these many data, these many things a candle tells us. Basically, it will tell in that particular time frame what was the highest point it reaches, what was the highest price it reaches, like if we are talking about a particular stock or be it like a future or option case. So it will tell the highest point, lowest point, where exactly it opened and where exactly it closed. Okay, so that's how it is supposed to be done. These are the four information every candle will tell. All right, and opening price or closing price, it depends where exactly it will be depending on the candlestick. So if nowadays the common one that we use is the green candlestick and red one. So let's say this is one green candlestick. Okay, now in this green candlestick, if green is the color of the candlestick, that means the prices has gone up. That means the opening should be at a lower pace. So this will be the open, this is the low, and this is the high, and this is the close. Okay, now if the candle is of red color, then it will be of opposite nature. Red means it is what I can say, the prices has gone low in that particular time frame. So this will remain the highest point, this will remain the lowest point, lowest price, but closing and opening will reverse. So basically this will be opening and this will be close. Because see, if the color is red, generally this one is nowadays what we are using, right? So if it is red, that means the prices has gone down. So if prices has gone down, that means it has opened at some higher level. So this is the opening price, this is the closing price, this will be the lowest point where it went, and this will be the highest point. But in the case of green one, green signifies the prices has gone up. So that means the prices has gone up. That means in starting position it was at the bottom. So this will be the opening one, this will be the close, this will be the highest, and this will be the low point. Okay, so generally if I'll talk about the common things between these two candles, that is, it is telling us about four things: where exactly it went up, or like what is the highest point, what is the lowest point, and where is the open, where was the closing, right? So these are the four information that is generally given by a candlestick. Now while using the exact same data, candlestick charts offer a much more visually appealing chart. Information seems to jump off the page computer screen. The information displayed is more easily interpreted and analyzed. The box below is a depiction of a single day of prices, showing the difference between the bar left and the candlestick. Okay, so yeah, this is figure 12.1, and these are the four information that is given over here. You can see how the name candlesticks came about. They look like a candle, obviously, that's why it is named as candle, right? So they look somewhat like a candle with a wick. The rectangle represents the difference between the open and close price of the day and is called the body. Notice that the body can be either black or white. So this is about the what I can say Japanese candlestick, but generally nowadays the one that we are using is mostly like the most common one that we are using. The candlestick is of either green color or red color. Green is when the prices are going up. Some people use it as like black and white still, so some people use it in some other manner as well, but generally mostly people are using green and red color. Green means the prices are going up, the red means the prices are going down in that particular time frame. Okay, time frame can vary, like it can be of 5 minute, 1 hour, daily or weekly, monthly, whatever it is, depending on the person, whatever the person chose, right? So yeah, that's how it is supposed to be done. So sometime somewhat like a candle with a wick, the rectangle represents the difference between the open and closed price of the body and is called the body. Notice that the body can be either black or white. A white body means that the closed price was greater, higher than the open price. Actually the body is not white but open, not filled, which makes it work better with computers. This is so in earlier times that's how it was supposed to be done. Nowadays also some people are using it. So just understand, okay, whenever the prices are going higher, I gave you the example of green and red. Here they are talking in terms of white and black, but the general idea is same only. They are telling us four things: what was the highest point the price reached in that time frame, what was the lowest point the price reached in that time frame, what was the opening, and what was the closing, right? So these are the four information that is given by a particular candle. White body means that the close price was greater, higher than the open price. Actually the body is not wide but open, not filled, which makes it work better with computers. This is so that it will print correctly when printing charts on a computer. This is one of the adaptations that have occurred in the West. The Japanese use red for the open body. The black body means that the close price was lower than the open price. So we'll just read through it. It is not that important because currently we are using something else. The most important part is you need to remember the four things a candle is telling us and how we can understand if the prices has gone higher or lower. Okay, now the open and close price are given much significance in Japanese candlesticks. The small lines above and below the body are referred to as wicks or hairs or shadows. Many different names for these lines appear in Japanese reference literature, which is odd since they represents the high and low price for the day and are normally not considered vital in the analysis of the Japanese, in the analysis by the Japanese. So this one, what they are calling as wick or shadows is basically this one, right? So this part is body and this is wick, like the wick of the candle, no? So this is the wick. So the top of the wick will be the high point and the bottom of the wick will be the low point. Okay, so yeah. Figure 12.2 shows the same data in both the popular bar chart and in Japanese candlestick format. You can quickly see that information not readily available on the bar chart seems to jump from the page screen on the candlestick chart. Initially it takes some getting used to, but after a while you may prefer it. Okay, so yeah, that's the basic idea. Like that's how they are representing it in candlestick chart, and this is basically the normal chart, bar chart. So in bar chart they are showing it like that. the opening and closing price in this manner, right? We have already covered this in the previous chapters. Now, in candlesticks, the white one and the red one or black one is used over here. Okay. Now, the different shape for candlesticks have different meanings. Now, this is important. The Japanese have defined different primary candlesticks based upon the relationship of open, high, low, and close prices. Understanding these basic candlesticks is the beginning of the candlestick analysis. Now, what are the basic candlesticks? Let's understand. This chapter is very important. Basic candlesticks. Different body shadow combination have different meaning. Days in which the difference between the open and close price is great are called long days. Okay. Days in which the difference between the open and close price is great are called long days. Likewise, days in which the difference between the open and close price is small are called short days. Remember, we are only talking about the size of the body, and no reference is made to the high or low prices. See figure 12.3. So this one, long days. Here the body is bigger, and here the body is shorter. So opening and closing price, opening and closing price. So if the difference between the opening and closing price is less, then we are calling it as a short day, and if the difference between opening and closing price is more, then we are calling it as a long day. Long day. Okay. Spinning tops are days in which the candlesticks have small bodies with upper and lower shadows that are of great length than that of the body. The body color is relatively unimportant in spinning top candlesticks. These candlesticks are considered as days of indecision. Okay. Spinning tops. Spinning tops. Okay. When the open price and the close price are equal, they are called doji lines. Doji is generally a candle that is, we can say, is undecisive in nature. Okay, when the open price and close price are equal, they are called doji lines. Doji candlesticks can have shadows of varying length. When referring to doji candlesticks, there is some consideration as to whether the open and close price must be exactly equal. This is a time when the prices must be almost equal, especially when dealing with large price movements. Okay, there are different doji candlesticks that are important. The long-legged doji has long upper and lower shadows and reflect considerable indecision on the part of the market participants. The gravestone doji has only long upper shadow and no lower shadow. Okay, the longer the upper shadow, the more bearish the interpretation. The dragonfly doji is the opposite of the gravestone doji. The lower shadow is long and there is no upper shadow. It is usually considered quite bullish. So yeah, this one is the doji candle in which the price is here in the middle, and this one is the second one, which is gravestone, that is bearish in nature. That means the prices, like the participant had tried to make the prices go up, but ultimately the prices closed down. So that means it is bearish in nature. Opposite to that, the participants in that particular time frame has tried to make the prices go up, but down. Ultimately, it went up. That means it is bullish in nature, which is a dragonfly doji. All right. Here the longer shadow is long and there is no upper shadow. Here the upper shadow is more and there is no lower shadow. And in the first doji, which was okay, the long-legged dozy has long upper and lower shadows and reflect considerable indecision on the market of price of market participants. Okay, so the first one is known as long-legged, the second one is gravestone, and the third one is dragonfly. So just remember it as like grave is under the ground. So just I'm giving you an analysis, right? Just to remember it. So grave is under the ground, so that is in bearish in nature, and dragonfly, so fly goes up, so that means it will be bullish in nature. Alright, it is usually considered quite bullish. The single candlesticks lines are essential to Japanese candlestick analysis. So this one is that. You'll find that all Japanese candle patterns are made from combination of these basic candlesticks. So these are the basic candlesticks that we have. Candle pattern analysis. A Japanese candle pattern is a psychological depiction of traders' mentality at this time. It vividly shows the action of the traders as time unfolds in the market. The mere fact that humans react consistently during similar situations makes candle pattern analysis work. So that's the basic idea, right? Why we are understanding this. So basically, if some pattern was made in the past, so that means the people under those circumstances acted in this manner, and we are thinking in the future if the similar circumstances will come, the human will act in similar manner once again. So that's the basic core of the candlestick pattern or candle pattern analysis, right? The mere fact that the humans react consistently during similar situation makes candle pattern analysis work. A Japanese candle pattern can consist of a single candlestick line or be a combination of multiple lines. Okay, normally never more than 5. While most candle patterns are used to determine reversal points in the market, there are a few that are used to determine trend continuation. They are referred to as reversal and combination patterns. Whenever a reversal pattern has bullish implication, an inversely related pattern has bearish meaning. Similarly, whenever a continuation pattern has bullish implication, an opposite pattern gives bearish meaning. When there is a pair of patterns that work in both bullish and bearish situation, they usually have the same name. In a few cases, however, the bullish pattern and its bearish counterpart have completely different names. Reversal patterns. A reversal candle pattern is a combination of Japanese candlesticks that normally indicate a reversal of the trend. One serious consideration that must be used to help identify pattern as being either bullish or bearish is the trend of the market predicting preceding the pattern. Reversal means if it was uptrend earlier, so reversal pattern means it will signifies now it will go in the downward direction, and vice versa. So earlier if the trend was downtrend and there is this reversal pattern that was observed, then it will go in the upward direction, it will turn into upward or uptrend basically. One serious consideration that must be used to help identify patterns as being either bullish or bearish is the trend of the market preceding the pattern. You cannot have a bullish pattern, reversal pattern in an uptrend. You can have a series of candlestick that resembles the bullish pattern, but if the trend is up, it is not a bullish Japanese candle pattern. Likewise, you cannot have a bearish reversal candle pattern in a downtrend. Makes sense? This presents one of the age-old problem when analyzing market. What is the trend? You must determine the trend before you can utilize Japanese candle patterns effectively. While volumes have been written on the subject of trend determination, the use of a moving average will work quite well. Okay, moving average work well with Japanese candlesticks candle patterns. Once the short term 10 periods or so trend has been determined, Japanese candle patterns will significantly assist in identifying the reversal of the trend. Okay, so to identify the trend, you need to use moving average, or like you can prefer the moving average. That's what the author is trying to say over here, right? Japanese literature consistently refers to approximately 40 reversal candle patterns. These vary from single candlestick lines to more complex patterns of up to 5 candlesticks lines. Japanese literature consistently refers to approximately 40 reversal candle patterns. Hmm. These vary from single candlestick lines to more complex patterns of 5 up to 5 candlestick lines. There are many good references on candlesticks, so only a few of the more popular patterns will be discussed here. Okay, dark cloud cover. So the first one is dark cloud cover. Let's understand that. This is a 2-day reversal pattern that only has bearish implication. Dark cloud will be bearish in nature. See figure 12.6. Okay, let's see the figure first. No, so this is the dark cloud. Okay, dark cloud. Okay, let's see. This is also one of the times when the pattern counterpart exists but has a different name. See piercing line. The first day of this pattern is a long white candlestick. So the white one is long in nature, right? That's what we have considered in the case of Japanese candlestick, and this one is representing the short one. Short one, in this candle the price is opened here. This is the opening and this is the closing. But in this case the price is opened here and this is the closing. So that's the difference between long and short. Okay, that's a very basic common example. Okay, right? So now let's understand it better. This is also one of the times when the pattern's counterpart exists but has a different name. See piercing line. The first day of this pattern is a long white candlesticks. This reflects the current trend of the market and helps confirm the uptrend of for traders. Okay, the next day open above the high price of the previous day, again adding to the bullishness. However, trading for the rest of the day is lower with a close price at least below the midpoint of the body of the first day. Close price at least below the midpoint of the body of the first day. So this will be the midpoint of the body of the first day, and the close is below this. So that's the pattern, right? So the trend was generally uptrend initially, and then the prices on the next day opened higher, and then it went on going down and down and down, and ultimately it closed below the what I can say midpoint of the previous white candle or bullish candle. Okay, this is a significant blow to the bullish mentality and will force many to exit the market. So a lot of people will exit the market. That means what they will do, they will, the bullish one will exit the market. That means they will become the seller. Since the close price is below the open price in the second day, the body is black. This is the dark cloud referred to in the name. Okay. Now the second one is piercing line. The opposite of the dark cloud cover, the piercing line has bullish implication. See figure 12.7. Let's see the figure. Okay, this one is piercing line. डार्क क्लाउड में क्या हो रहा था कि ट्रेंड अप ट्रेंड में था तो वो डाउन ट्रेंड में आ जा रहा था, बियरिश इम्प्लीकेशन दिखा रहा था. पियर्सिंग लाइन में उल्टा हो रहा है. देखो ये वाली जो कैंडल है, फर्स्ट कैंडल जो है, इसका जो भरी हुई है ना, ये ब्लैक कलर से जो हम यहाँ पे डिनोट कर रहे हैं जैपनीज कैंडल स्टिक में, यहाँ पे हो रहा था कि जो अगर ब्लैक है इसका मतलब इसके ओपन ऊपर हुआ है और क्लोजिंग नीचे आई है, ठीक है. और वाइट है तो उसका उल्टा होगा, वाइट में क्लोजिंग ऊपर होगी और ओपन नीचे हुआ होगा, राइट. तो यहीं पे ये पियर्सिंग वाला केस आ रहा है कि पहली वाली कैंडल जो थी वो डाउन ट्रेंड को रिप्रेजेंट कर रही थी, ओपन हाई हुआ था और क्लोज नीचे हुआ था. बट जो नेक्स्ट कैंडल आई है, इवन दो उसकी ओपनिंग जो ये वाली कैंडल है उससे नीचे हुई है. ऐसे समझ लो कि मान लो यहाँ पे 100 मान लो, ठीक है. पिछली वाली कैंडल का जो ओपन था वो 100 था और क्लोजिंग समवट यहाँ पे 80 पे आई है. तो जो अगली वाली कैंडल है इसकी ओपनिंग तो 70 करीब से कहीं से हुई है, बट फिर प्राइस बढ़ता बढ़ता 80 से ऊपर मान लो यहाँ पे 90 कहीं पे क्लोज हुआ है. तो इस वाली कैंडल में अगर देखा जाए तो प्राइस 70 से बढ़ के 90 तक गया है, और इस वाली कैंडल में 100 से 80 आया था. तो ये बियरिश थी नेचर में, बट जो नेक्स्ट कैंडल आई है वो बुलिश आई है क्योंकि इसमें प्राइस बढ़ा है, तो ये बुलिश आई है नेचर में. तो यहाँ पे जो लास्ट ट्रेंड है, जो जनरल ट्रेंड था डाउन ट्रेंड, उसके भी अपोजिट आई है क्योंकि यहाँ पे एक अप ट्रेंड का सिग्नल दे रहा था. तो ये वाला पियर्सिंग लाइन है, राइट. और ये वाले केस में उल्टा हो रहा था. इसमें क्या हो रहा था कि पहले प्राइस ओपन नीचे हुआ था और हाई गया था, ये अप ट्रेंड में था, लेकिन अगला वाला ओपन भले ही ऊपर हुआ था प्राइस, लेकिन वहाँ से नीचे आया है. सो या दैट इज द पियर्सिंग लाइन. Evening star and morning star. Now the next one is evening star and morning star. Let's understand about those as well, right? Piercing line. Evening star and morning star is something that you have heard many a times. The opposite of the dark cloud cover, the piercing line has bullish implications. The scenario is quite similar but opposite. A trend is in place. The first candlestick is a long black day which solidifies traders' confidence in the downtrend. The next day prices open at new low and then trade higher all day and close above the midpoint of the first candlestick's body. This offers a significant change of the downtrend mentality and many will reverse or exit their position. So initially the sellers, now they will liquidate their position. That means now they will close their position. So sellers will have to become a buyer when they will close their position, right? So yeah, so they will support the uptrend and the market will move up after that. That is in the case of piercing one, this one. Okay, now the evening star and morning star. The evening star and its cousin, the morning star, are two powerful reversal candle patterns. These are both 3-day patterns that work exceptionally well. So here they are saying it is 3-day, but you can understand like 3 candle. Okay, so if you are using time frame of 5 minutes for an example in future and trading, so you can understand the last 3 candles will be in this manner. So we'll say okay, this is a evening star or a morning star depending on these conditions. Let's understand about those conditions now. These are both 3-day patterns that work exceptionally well. Okay, The scenario for understanding the change in trader psychology for the evening star will be thoroughly discussed here, since the opposite can be said for the morning star. Okay, so this one is evening star. So that means this was bullish in nature. The prices opened lower, but then it went up. Then again, this one is bearish in nature. That means the prices opened higher, but then went lower. This is again bearish, because in Japanese candlesticks, that's what we learned, right? The black one is signifying the bearish candle, and the white one is representing the bullish candle. So here, one bullish candle followed by two bearish candle, then will change the trend, and from here the trend will become a downtrend, which was initially a uptrend, an uptrend, right? And evening star will be so morning star will be opposite to that. Evening star, that means evening, that means you can think it of like evening means down, and then it is representing the downtrend, like it is a reversal pattern for downtrend. The morning star will be opposite. Morning means something that goes up. So yeah, it is something that I'm telling you to just remember, okay, and for me to also remember. That's why I'm saying it. Now in the morning one, there is two bearish candles followed by one bullish candle. So here the market, which was initially an downtrend, will go uptrend, which will change the uptrend. Let's understand the psychology behind it. Okay, we understood the patterns like the diagram. Now we will go further ahead. Diagram हमने समझ लिया, अब आगे को चलते हैं. The evening star is a bearish reversal candle pattern, as its name suggests. ठीक है, evening star bearish होता है, that is important. Evening star is a bearish reversal pattern, as its name suggests. The first day of this pattern is a long white candlestick which fully enforces the current uptrend. On the open of the second day, prices gap up above the body for the first day. Trading on this second day is somewhat restricted, and the close price is near the open price while remaining above the body of the first day. The body for the second day is small. This type of the day following a long day is referred to as star pattern. A star is a small body day that gaps away from a long body day. The third and last day of this pattern opens with a gap below the body of the star and closes lower with the close price below the midpoint of the first day. The third and last day of this pattern opens with a gap below the body of the star and closes lower with a close price below the midpoint of the first day. Understood. Now that's what they are trying to signify. The first day, this and this. So this was the opening and this was the closing for the first day, right? The second one, the opening was higher, but the closing was somewhat near the closing of the previous day, right? And then in the next day, opening here and closing is below the midpoint of the first day. So here is the closing. So yeah, that's the signal that the trend is now going to be bearish in nature. So this is evening star. Okay. Now the previous explanation was the perfect scenario. Many references will accept as valid an evening star which does not meet each detail exactly. For instance, the third day might not gap down on the or the close on the third day might not be quite below the midpoint of the first day's body. These details are subjective when viewing a candlestick chart, but not when using a computer program to automatically identify the pattern. That is because computer programs require explicit instruction to read the candle chart and don't allow the subjective interpretations. Okay, continuation pattern. So we understood the evening star and the opposite of it will be morning star. We already understood that as well, right? In the morning star, there is two bearish candles followed by one bullish candle, which is the closing of which is going to be more like higher than the midpoint of the first candle. So this is the closing of the third candle, which is higher than the midpoint of the first candle. Understood. Continuation patterns. So these are two, like the morning and the evening star is reversal pattern. Evening star being the bearish reversal pattern and the morning star being bullish reversal pattern. Now we will talk about the continuation patterns. Each trading day, a decision needs to be made whether it is to exit a trade, enter a trade, or remain in a trade. A candle pattern that helps identify the fact that the current trend is going to continue is more valuable than many first that then may first appear. It helps answer the questions as to whether or not you should remain in a trade. Japanese literature refers to 16 continuation candle patterns. One continuation pattern is and its related opposite cousin are particularly good at trend continuation identification. Rising and falling three methods. The rising three methods continuation candle pattern is the bullish counterpart to this duo and will be the subject of this scenario building. A bullish continuation pattern can only occur in an uptrend and a bearish continuation pattern can only occur in a downtrend. So continuation pattern means it will occur like if the trend is up, so the bullish continuation pattern will occur. If the trend is down, the bearish continuation pattern will occur. That is a very easy explanation to the same. This restates the required relationship to the trend that is so necessary in candle pattern analysis. Okay, figure 12.10 and 12.11. Okay, so this one 12.10 is rising three methods. Okay, so that is the bullish continuation pattern, because here you can see the prices are going up, so that means the market was in uptrend, then this pattern occurred, and then again the prices went up, so that means the uptrend continues, so that is bullish continuation pattern. Opposite to that, here we have falling three method, which is okay, which is bearish continuation pattern. Here the prices were going down and this pattern was made, then the prices again went down, so that means the continuation pattern occurred for the like bearish continuation pattern here. The first day of the rising three methods pattern is a long white day. Okay, now we are understanding it one by one. Okay, shall we continue it or shall we cover it in the next one? Okay, so I think okay, let's cover this. Ah, shit. Just give me 1 second. Okay, let's understand this one and then we will continue the later part in the next one. The first day of the rising three method pattern is a long white which fully supports the uptrending market. However, over the course of the next three trading periods, small body day occur which as a group trend okay, pips in my pocket. I just stumble upon the live and your reading read you reading this book, but let me tell you that this book is not good. It's full of retail logic. Okay, thank you for the suggestion, but it will be good for the what I can say beginners or like intermediate level. We will understand some basics, right? So that was the very idea. I have heard about this book like as a what I can say. This is known as the Bible of trading, is what I heard. So that's why I'm going through this book, and I'm at page number 283, and I'm getting the basics. So it's doing its job. But your point is also understood. Pips in my pocket. Got your point. Thanks for your suggestion, bro. Okay. Is there any technical mistakes? If you can identify, like if you can just tell me that. Is there any technical mistakes? Is it good for like beginner and intermediate level, I guess? Isn't it? Thank you for your suggestion, brother. Now, moving ahead. Hmm. Where were we? The first day of the rising three methods pattern is a long white day which fully supports the uptrending market. However, over the course of the next three trading periods, small body days occur which, as a group trend downwards, they all remain within the range of the first day's long white body, and at least two of these three small body days have black bodies. This period of time when the market appears to have gone nowhere is considered by the Japanese as a period of rest. On the fifth day of this pattern, another long white day develops, which closes at a new high. Prices have finally broken out of the short trading ranges, and the uptrend will continue. A 5-day pattern such as the rising three methods require a lot of details in its definition. The above scenario is the perfect example of the rising three method patterns. The flexibility can be applied with some success, and this only comes with experience. For example, the three small reaction days could remain within the first day's high-low range instead of the body's range. The small reaction days do not always have to be predominantly black. And finally, the concept of the period of rest could be expanded to include more than three reaction days. Don't ignore the rising and falling three methods pattern. It can give you a feeling of comfort when worrying about protecting profits in a trade. Okay, noted. Alright, so let's just understand it better with the help of the diagram. It's this OBS thing, no? It just boils my blood many a times. We have to set it again and again. Alright, so this was the rising three methods. So here the market was in uptrend, clear uptrend. Now this is again a bullish candle. That means the prices opened at lower and then it closed at higher. So this is the closing, followed by three candles which was somewhat in the similar range. So this is the highest point and this is the lowest point. Next three candles are between these only, between these point only. So these three candles are opposite in nature of the trend, which was uptrend, and now these three are bearish candles. Then the next one, the fourth day candle, made so big that it comprises all these three prices and it broke the highest price of the first day candle as well. So that means that the uptrend will continue, and this method is rising three methods. Opposite of that, falling three methods. So there is this bullish candle, next three candle, it can be of any color, but it was between these range, and the next decisive candle was okay, it is breaking the lowest point of the first candle, and now the downtrend will continue. Initially it was a downtrend, and after this pattern again the downtrend continues. So that's why these are the continuation patterns. Okay, so here we understood these points as well. So yeah, shall we keep it up here? Let's complete page number 283. Then we'll go further ahead. Using computers for candle pattern identification. A personal computer with software designed to recognize candle patterns is a great way to remove emotions, especially during a trade. However, there are a couple of things to keep in mind when viewing candlestick on a computer screen. A computer screen is made up of small light elements called pixels. There are only so many pixels on your computer screen, with the amount based upon the resolution of your video card monitor combination. If you are viewing price data that has a large range of price in a short period of time, you may think that you are seeing many doji days, open and close price days, but in fact you are not. With a large range of price on the screen, each pixel element will have a price range of its own. A computer software program that identifies pattern based on a mathematical relationship will overcome this visual. Okay, this is not relevant in nowadays, because see, this book is written way what I can say, many years ago. So yeah, certain things are not relatable, but from a beginner point of view and intermediate point of view, we are understanding the basics of it, which is more than enough. I was just curious to learn this particular book since I have heard it many places, and it is termed as Bible of Trading. So that's why I'm just covering it by just understanding the basic and covering everything here. But we will only emphasize on the things that are relatable nowadays as well. And meanwhile, if someone is trying to understand the trading for the first time, so they will get the general idea. So that was the whole plan of covering this book. Hopefully the above explanation will keep you from thinking that your software isn't working. Okay, that is again all right. So we have covered till page number 283. Pips in my pocket. All right. ICD says that it is a Bible of retail traders. Read it and just remember these are the things that not to do. It's not a beginner thing. By the way, I am a funded trader and telling you for your benefit. Duly noted, brother. And thank you for your suggestion, brother. Retail traders, all right. So that focuses the retail trader is what you are trying to emphasize over here. Read it and just remember these are the things that what not to do. Okay, it's not a beginner thing, but by the way, I'm okay. All right, duly noted, brother. Thank you for the suggestions. All right. And if there is any other book that you want to suggest after this book, I'll cover that book as well. So the point that you are trying to make over here is that it should be considered from retail traders' perspective, right? Duly noted. Anything, any other book that you want to suggest, since you are saying that you are a funded trader? Pips in my pocket. Alright, so people who are here for the first time, if you have minor, even the minor interest in stock market, finance, or trading or any such things related to this basket, then you can check out my channel and you can subscribe to my channel as well, because in future that's what I'm going to cover in detail. So this is my learning journey, and along with which we can grow together. So that's the basic idea, right? I know about a lot of things. It's not like I'm reading this for the first time, but I'm covering it from the scratch. So yeah, if you are into stock market, finance and related things, then you can subscribe to the channel and like the live stream as well, if you feel like, only if you feel like it is going to add some value in your life. All right, so yeah, that's the basic idea. Thank you so much for being here. We'll cover from page number 284 in the next live onwards. And yeah, thank you so much for being here. Thank you so much, universe. Thank you so much, Radharanji. Have fun. Peace out. Watch ICT videos and read Trading in the Zone. Trading in the Zone is, I have already read it. It is about the, it is a book by Mark Douglas, right? If I'm not wrong. And it is about the trading psychology, to be very precise. Trading in the Zone, The Disciplined Trader, The Trading in the Zone. These are the books that I have already covered. This is my third one, which is more technical in nature. Correct? Trading in the Zone is by Mark Douglas, isn't it? Pips in my pocket. Am I right? Or am I just forgetting something? This is a book by Mark Douglas, and The Disciplined Trader is also by Mark Douglas, right? Yeah, okay. Alright, thank you so much for the suggestion. Thank you so much for being here, Pips in my pocket. And everyone else also, make sure that if you have any interest in trading psychology, trading, stock market, and finance in general, then you can subscribe to the channel and like the live stream as well. So we'll meet next time. Till then, stay healthy, stay safe. Please take care. Bye bye. Have fun. Thank you. For technicals, you should watch ICT. Okay, duly noted. I'll do that as well. Thank you for the suggestions once again, Pips in my pocket. Have fun. Peace out.